Okay, we're gonna get started. Thanks for being here today. So good morning. My name is Remy. Can you hear me well? Yeah. Okay. Good. Um, my name is Remy Jadvab. I'm the director of the Institute for International Economic Policy and also professor of economics and international affairs. At IEP, we're a very active research institute. Just last week during the spring meetings, we had our GW India conference and our GW Africa conference, and this week we have a GW China conference. We also organize major conferences with World Bank on urbanization and sustainable development. So you can find more about our activities at IEP on our website. Today, it is my pleasure to welcome you to the 16th edition of the GW IEP conference on China's economic development and US-China economic relations. Um, Obviously, understanding what's happening, in China's economy and in the relationship between the US and China is very important for the future of the global economy. It's also very important for our students in their career. Uh, Unfortunately, we're 10 days away from the final exam period, so I don't know if we're going to see a lot of our students, but the students that came today, thank you for coming. It's very brave of you. I'm pleased that over the last 16 years, it's been 16 years already, this conference has always featured cutting-edge research and high-level policy engagement that takes a non-partisan approach to investigate the core issues and to inform the policy debate here in Washington, D.C. and abroad. Lastly, I would like to thank my colleagues who were responsible for organizing a conference, Prof. Maggie Chen, Prof. Chao Wei, Prof. Jeffrey Ding, Prof. Stephen Kaplan, and also IIP distinguished scholar Barbara Stallings, who I think is not here today. So it was very nice of her to pitch in, although she could not make it. Also, I would like to thank our staff, student staff in particular, and Kai Renner, who's the assistant director of IEP. Lastly, I want to acknowledge the financial support of Ning Li, Frank Wong, Dan Stramelo, and the IEP Executive Circle. Ning Li is an alumnus of the Edo School and a member of the school board of advisor. And he has established a Ning Li Family Endowment for US-China economic relations. Frank Wong is a Yale School alumnus, an IEP Executive Circle member who has established a Frank Wong Endowment. And Dan Stramelo is a Yale School alumnus and a member of our Executive Circle, has also always supported the conference. Thanks to Ning, Frank, Dan, and the IEP Executive Circle, the study of China will remain an important topic for the school and IEP in the years to come. It is now my pleasure to introduce our keynote speaker, Dr. Sonali Jain-Chandra, who will speak on China outlook and policies. Our presentation will discuss findings of the recent IMF Article 4 consultation with China, focusing on key policy challenges with specific focus relating to the property sector adjustment, local government financing pressures, and fragmentation. Sonali Jain-Chandra is a division chief and mission chief for China in the IMF's Asia and Pacific department. She has wide-ranging country experience at the IMF and has also worked on India, Korea, Indonesia, Hong Kong, SAR, Cambodia, Ethiopia, Nepal, and Bhutan. She was also in the Asia and Pacific Department Regional Studies Division and has authored many chapters of the Regional Economic Outlook of the IMF. The Regional Economic Outlook is one of my favorite publications. I always tell my students to read it every year to be up to date on what's happening in the world. So that's a very useful publication, I think, for teaching. Dr. Jain-Chandra also previously worked in the IMF Strategy Policy and Review Department on vulnerabilities in emerging markets and advanced economies. Our research interests have mainly focused on capital flows, international banking linkages, labor markets, fiscal rules, microeconomics of gender, and financial inclusion and deepening. Finally, she holds a PhD in economics from Columbia University. Following her keynote remarks, IEP faculty affiliate and former IEP director Maggie Chen, who's here, will be moderating the audience Q&A and period. Without further ado, please join me in welcoming Dr. Sonali Jain-Chandra to the Elliott School and the George Washington University. Thank you.
Morning, everyone. Thanks very much for the kind introduction. It's a pleasure to be here this morning to deliver the keynote speech for this conference. As my slides are entitled, I will speak about the economic outlook for China as well as the key policy challenges facing the economy at this juncture. The findings that I will discuss relate to our Article 4 consultation, as we just mentioned. This is based on the work the team has done this year and last year for our analytical work relating to China. We have a number of working papers. I think I will give a broad overview of the policy challenges, but underneath all of this, there's in-depth research and papers that are available on the IMF website, and I would refer you to those. So without further ado, let me get started. The clicker is not working, so bear with me. Okay, here is the roadmap for my remarks and presentation this morning. In the presentation, I will first take a look at where China stands in its economic recovery and the near-term outlook for the economy, as well as talking about our recommendations for fiscal and monetary policy for China in the near term. Next, I will turn to managing the risks from the ongoing correction in the property sector, discussing its ripple effects on local government financing, as well as the broader financial system. After covering the most pressing issues in the near term, I will shift focus to the medium-term outlook, which we see as a secular slowdown after 2025 in China. I will argue that a comprehensive set of reforms, including to boost productivity in China, can lift Chinese potential growth, which of course is important for China, but it's important for the rest of the world as well. And to wrap things up, I will touch upon spillovers from a slowdown in China, as well as growing fragmentation pressures. Turning first to near-term macro outlooks as well as policies. Let me begin by giving a very brief overview of the current macro conjuncture. So China's recovery from the pandemic is quite distinct from recoveries in other countries globally that we have seen. The recovery from the pandemic has been beset in China by subdued confidence as well as lowflation. I personally don't like the term deflation because I don't think it's accurate. So I would characterize it as a situation of low confidence as well as lowflation. So as you can see from the left-hand side chart, since 2022 second quarter, which is when the Shanghai lockdowns happened, China's consumer confidence has been at record lows, and it hasn't improved even with reopening and sort of a boost to headline GDP growth. Also, as is widely reported, and I think there are many concerns around this, China's inflation has remained very subdued. It has slipped into deflationary territory on account. I think that was primarily driven by weak food and energy prices. Having said that, producer prices remain in negative territory, and this, of course, has implications for corporate profits, for investment, etc., going forward. So this is not a good development. So let me go a little bit more sort of granularly in terms of what's been happening in the economy. The left-hand side chart shows China's economic recovery, or basically using the quarterly sort of GDP. And it basically what we can see here is 2023 Q1 is when the economy essentially reopened, right? So you had a boost to consumption. Private consumption is the blue bar. This is the component of GDP that really suffered during the pandemic. Consumers were very restrained. And so you see initially that because of the low base from the pandemic, you see growth being driven by private consumption, by households, but essentially you also see sort of towards the middle of the year, Chinese economic recovery starting to slow down because of the factors that I had mentioned, which is sort of weak consumer confidence as well as weak labor market conditions. And you see that sort of in the second half of the year, China's economic growth last year was driven by the public sector. So as the private sector confidence started waning, consumption was weak, fiscal support was delivered. Now, we just recently received Q1 data, and I think their private consumption is strong, but I think we have concerns around this durability of the recovery going forward. The right-hand chart shows our latest revisions. I think this is more for, this is more of interest to people who focus on sort of high frequency indicators in China. Just to recap this, I won't go into too many details here in the interest of time, but just to say that for 2024, we're forecasting China's growth at 4.6%. This is before Q1 came out. There's upside risk going forward. And this is a little bit below the government's target. I wanted to talk a little bit about the risks the Chinese economy faces. The outlook ahead is, I think, beset with downside risks, and you can see both upside and downside risks to the Chinese economy. In our view, the property sector is the main cause of concern. It's a key factor that could shift growth away from the projected path. I think continued delays in dealing with developers in China, limited house price adjustments could fuel expectations of future price declines and prolong the adjustment that's going on in the property sector. And I think I'll speak to this in a little more detail. But just to flag, this is a key downside risk from our perspective. Another risk that I'm going to focus on a little bit later on is the financial conditions of local governments, which rely on the property sector for their revenues, and therefore they face financing constraints. Of course, this has implications for domestic demand more broadly in China, as much of the fiscal support is delivered by local governments, given decentralization in China. Weak demand, of course, can then propagate potentially to balance sheet stresses and the need for repair in the corporate sector more broadly, as well as households. We see that as another key risk. And on the external front, there's no shortage of challenges that I'll speak to, including weakening demand, tightening financial conditions, fragmentation. There's a series of risks there. I think to be balanced, we also see some upside risks, and we saw that towards the end of last year when the government stepped in with stronger policies, and that could happen again, which could lift Chinese growth. So in the face of subdued demand, as I'd mentioned, a still negative output gap, the prevalence of all of the downside risks, what is our policy advice to the government on macroeconomic policies? We essentially recommend that fiscal policy should remain neutral, and I'll explain now in a bit why we don't think there should be large fiscal expansion in China. We also think that additional monetary policy support will help secure the recovery, given the factors that I had mentioned. However, I should say it's not the level of support that's delivered to the economy that matters only. It's also the way in which the support is delivered that can affect how effective, how adequate it is to boost economic growth. And I think our work has shown that it's very important to reorient fiscal spending in China towards household and rely more on interest rates in monetary policy loosening. And I will turn to these issues in turn next. Now I turn to why the neutral fiscal stance, it's working? Okay, thank you. Now I'll turn first to why we think that China should run a neutral fiscal stance for this year, but over the medium term, there's a need to consolidate China's fiscal position. It's true that China has some fiscal space, and the government can, finance its debt at favorable rates due to ample domestic savings and financial repression. However, the risks from further increases in government debt ratios will get progressively more difficult to manage going forward. You can see that on our baseline in the right-hand side chart, actually, due to aging pressures and growing pension reforms, debt can increase rapidly in the absence of fiscal consolidation going forward. And the left-hand side chart gives you a bit of a cross-country perspective in terms of our expectation of debt growth. And so this underpins our advice to the government to undertake fiscal consolidation once the recovery is secure, the output gap is closed, for the general government debt to stabilize over the next 10 years or so. Another sort of important aspect of our fiscal policy advice is the need to structurally reduce precautionary savings in China using fiscal policy. And we think this will require strengthening the social protection system. The chart on the left-hand side shows that China's social protection spending is low in international comparison, with only 3 countries spending less on social protection. China is the blue bar here. So this essentially means that households need to self-insure have high amounts of household savings, and therefore they don't spend consistent with what other countries do. And also, let me delve a little bit more into the social protection system. We see that higher unemployment as well as medical insurance benefits will provide individuals across the income spectrum with more financial protection in the event of unanticipated employment loss or health costs. And so that will reduce the need to self-insure and reduce precautionary savings. So let me explain a little bit the right-hand side chart, where China, again, is this red dot here. And what we see here is so if the horizontal axis measures coverage, and the vertical axis measures adequacy. And so compared to even in emerging markets, let alone advanced economies, we see that Chinese households don't have adequate social protection. Now, the fiscal reforms that I had mentioned in terms of boosting social protection will also help. I mean, it will help in terms of rebalancing the economy, but it'll also make fiscal policy a more effective tool of macroeconomic stabilization going forward. This is because, in our view, infrastructure investment, which is where a bulk of where government spending has been directed, is facing diminishing returns in China. And I'll get to this when we talk about the medium term. But essentially, what we think is that the fiscal multiplier in China, which is the effect of fiscal support on growth, is highest when spending is geared towards means-tested transfers to household. This is the bar on the right-hand side. And you can see the fiscal multiplier there is around 1.5, as opposed to public investment, where it's clearly less because of diminishing returns to investment. And also, this also applies from a welfare standpoint if you look at the effect on consumption. So we think that the countercyclical role of fiscal policy can increase also by reorienting spending away from investment towards transfers to households. Also, the countercyclicality of fiscal policy can be boosted by tax reforms, and this speaks to the chart on the right-hand side. Revenue from personal income taxes, which is typically one of the most progressive taxes if implemented in a certain way, is one of the lowest in China compared to its G20 peers. And so our recommendation is to increase the reliance on personal income taxes, which will act as an automatic stabilizer for the economy. Turning now to monetary policy. As with fiscal policy, how monetary policy is implemented can also matter for growth. So as is well known, about a decade ago, the PBC began gradual interest rate liberalization and was moving towards implementing a price-based monetary policy framework. But at this current juncture, the reliance on interest rate changes remains very low in China in international comparison. And you can see this in the left-hand side, in particular since the onset of the pandemic, or maybe even a few years before. So let me explain the chart on the left-hand side. This is the 3-year rolling sum of changes in the policy rate. China is the red line here, and you have sort of the 10th and 90th percentile, that's a shaded area, and the blue line is the median. And so essentially, you can see, compared to other countries, China relies much less on changing interest rates. And then this was the time of a very large negative output gap. You would expect the monetary policy response there to be slashing interest rates, as was done elsewhere in the world. Now, so what does that really mean? It means that monetary policy in China is much more reliant on using credit tools. These are the structural credit policies of the People's Bank of China. Now, there's no simple quantitative indicator to summarize the stance of credit policy, but you can see on the right-hand side chart, the PBC rediscount and re-lending facility, the sort of stock of that support is increasing quite rapidly. So there's clearly more of a reliance on structural credit policies rather than interest rate policy, which is in contrast to the rest of the world. Just very briefly on why does this really matter? Why does it matter that they rely more on credit policy? So our analysis, this is based on 14,000 firm level data, very detailed analysis. But I'll just give you the punchline, which is we think that interest rate shocks significantly lift investment of credit constrained firms, so the small firms, as opposed to credit shocks. So the left-hand side is the impulse response on interest rate shocks, and the right-hand side is credit policy shocks. So these are more effective. Interest rate changes are more effective at delivering support to credit constrained firms, thereby underpinning our recommendations to rely more on interest rates. So let me turn to the next section of my presentation, which is managing the property sector adjustment that China is going through. What are the implications for local government finances as well as financial sector risks? Let me give, this is what's going on in the property sector right now, and then I'll take a bit of a medium-term view. One of the major drags on growth as well as risks in our view is the continued contraction in the property sector in China, the property sector adjustment. Notwithstanding considerable policy support that's been delivered, and I will come to that in a second, you can see that the property sector correction continues. This hasn't reached its trough yet. And you can see that in a variety of real estate indicators. You can see that real estate investment has declined by about 25% since its peak in 2021. Housing starts have crashed by close to 50%, which of course has implications for investment going forward. And the same with sales. And we haven't seen bottom, and we don't expect it to bottom out anytime soon. In addition to this, this has led to essentially financial distress amongst China's developers, which were a significant contributor to growth going forward, right? So you see that basically they used to rely on pre-sales of homes to the population that was a key source of financing. And because home buyers have lost confidence in the ability of developers to deliver housing, and sales are weak, right? So that's why their finances have suffered. And we estimate that around half of developers in China are essentially now insolvent. And this needs to be tackled more proactively. I'll get to that in a second. A quick point on how is Chinese property sector adjustment different than crises on real estate crises that we've seen elsewhere in the world. We see that notwithstanding the sharp correction on the quantity side, prices have not moved in China. So you can see in the right-hand side chart that prices of newly constructed homes have declined by about 4 or 5% peak to trough. I mean, this is much less than the adjustments where we have seen where prices do their part and you reach a new equilibrium faster. Now, looking ahead, we see that property sector weakness is likely to continue in China. This is based on, again, a detailed study that we had done earlier this year that's available on our website. We estimate the fundamental demand for housing over the next 10 years relative to 2012 to 2021. This takes into account China's expected demographic trends, the impact on household formation, as well as the replacement demand for housing. We also adjust this for supply side distortions, including the inventory overhang. And our estimates suggest that demand in the coming years in China is set to decline anywhere in the range of 35 to 55% relative to the past decades. Now, these calculations are very sensitive to the extent to which the urban household formation ratio will change. So that in a way explains the upper and lower bound, but it's still a large drop no matter how you slice it. The right-hand side chart translates this into the impact on gross capital formation, gross fixed capital formation for the real estate sector. And there we find that this could decline by between 30 to 60% compared to the peak. Now, these look like very large numbers, but I have to remind everyone that they are not that different than the kind of adjustments we saw during the property sector, crises in the United States and Spain, et cetera. So it's consistent with what we've seen elsewhere. In response to this, of course, the authorities have taken many, many steps. They have been proactive on the policy side. Won't get into the details of this given in the interest of time to say that they have taken measures on the demand side, supply side. They've tried to increase financing to developers to get housing completed. But we think that while these measures are welcome, more needs to be done. And restructuring of developers, which is a key bottleneck in terms of restoring confidence to the sector, remains slow. The incentives for restructuring are weak, including limited price adjustment, as I had mentioned, and a number of financial sector policies that impede it. So we think more needs to be done. What more needs to be done is listed here. I think first and foremost, it's important to have a comprehensive policy package to accelerate the exit of non-viable developers, as is done anywhere else in the world. It's important for the central government to step in to complete unfinished housing, because this is a key reason why you can't restructure the developers, because households would bear a disproportionate cost in terms of, if there's non-delivery of housing. And local governments don't have the financial strength to do it. So the central government needs to step in and with carefully designed policies to complete this unfinished housing. There's also a need to assist viable developers. The government needs to take a coordinating role to repair their balance sheet, so there's a functioning property market going forward. And then finally, there are a series of structural reforms, including, I talked about reliance on pre-sales for financing of housing. I think that needs to be revisited in the medium term. There needs to be more house price adjustments so that home buyers are comfortable purchasing homes. And they're also undertaking, I think, some social housing initiatives which are welcome, and that can also lift the property sector going forward. Now, a key vulnerability following from the property sector crisis is the financial weakness of local governments. So, as is well known by China watchers, local governments in China suffer from a significant vertical imbalance. And by that, I mean that local government revenues are not sufficient, revenues and transfers, I should say, from the central government are not sufficient to meet the expenditure mandates. And over time, also, local governments have been tasked with delivering very ambitious growth targets, and they have overinvested, as is well known, to do so. And so you clearly have a flow problem on the local government side. And this, at the current juncture, has been amplified by the weakness in the housing sector, as local governments, which previously depended heavily on revenues from land sales, they don't have that source of revenues anymore. So that's a flow issue right now that is quite pressing. I think there is also a stock issue. As a result of the accumulated large deficits in the past, local governments face a very high debt level. And this speaks to the chart, the left-hand chart speaks to this point. You can see this is by income quintile of different provinces. You can see in all but the richest provinces, which is the fifth quintile, debt levels, this includes both on and off budget debt of local governments, is considerably higher than 60% of GDP, which is of provincial GDP, which is the government's threshold for measuring riskiness of it in terms of indebtedness. So clearly they're over-indebted. Now, what does this mean? It means also, and also taking into account that local government financing vehicles, which have done much of this investment for China, many of them don't have sufficient revenues to even meet the interest expenses. So essentially, they are unsustainable. And we think that at some point, in a carefully done way, restructuring of this debt will be needed in China. This, of course, has significant spillovers to other sectors, because local government financing vehicles, which is the center, if you look at this is based on financial accounts, detailed financial accounts of these enterprises. They're at the center, right? So, and they have links to various sectors of the economy, including, of course, the local government, but also local financial institutions, other corporates by way of accounts payable to households which own wealth management products that are linked to local government financing vehicles. So they're at the center. They're highly interlinked. So whenever restructuring is done or financial stress occurs in LGFEs, it clearly has implications for the broad economy. Moving on. So what is our policy advice in terms of dealing with these local government debt issues, as I had mentioned? I think the authorities are very cognizant of the risks that this poses. I think there's been considerable emphasis placed on it at a very high level in terms of the need to proactively tackle this. However, we think that more specific measures that hopefully the authorities are working on will be unveiled in due course. And we think a policy package to deal with these risks will, as I'd mentioned earlier, will need to find a way to restructure the unsustainable LGFE debt. This should rely on facilitating debt write-downs as well as asset sales. And this can be pretty problematic because the local governments rely on these for fiscal support. And so enough central government support has to be provided to local governments to provide essential services and to maintain the continuity of that. There's also a series of coordinated fiscal reforms that need to be done in terms of tax reforms to reduce the reliance of local governments on land sales, more transfers, et cetera, et cetera. I won't go into all of this in the interest of time. Now, moving on to the financial sector, the stress in the property sector in China, as well as local government finances, can potentially lead to financial sector spillovers. As the left-hand side chart shows, both banks as well as non-banks in China have significant exposure to both the property sector as well as local government financing vehicles. At this point, the asset quality risk from stress in this sector is not yet fully recognized because there's extensive forbearance in the Chinese financial system. So this is a latent asset quality risk that's not fully visible at this point. Now, I should note that at this time, the Chinese financial sector is under considerable stress due to weak profitability, and you can see this in the right-hand side chart. Net interest margins in China have declined rapidly for a variety of reasons. Again, in the interest of time, I won't get into this because I want to move on to medium-term policies. I think I will skip this. Our reports have a series of very detailed recommendations on what should be done on the financial sector. I won't get into this in the interest of time because I do want to get to medium-term issues and international spillovers. Okay, turning now to medium-term growth. As is well known, China has seen very impressive. Let's step back, actually. So China, if you look at the last 3 decades, China has seen very impressive growth. It's been unsurpassed, well over that has been enjoyed by peer countries. So the chart on the left-hand side shows residuals from an unconditional convergence regression. And what we see here is that from the 1990s, China has significantly positive residuals, averaging about 5.5% of GDP. Now, this means China was growing much faster than what its level of per capita GDP based on a standard convergence regression would suggest. And the world, it had significant spillovers to the rest of the world. China's rapid growth after sort of market-based reforms, WTO entry, et cetera. Now, our projections suggest that the 3 decades of overperformance of China are set to end going forward. So if you look at our projections, about 4 years out, we're projecting Chinese growth at around 3.5% of GDP. The residuals here are 0. This means that China is going to grow as fast as what would be expected based on its per capita income, no faster. So this is a very different situation in terms of Chinese growth vis-a-vis history, and that has implications for the rest of the world. Now, why do we have quite a sober outlook for China in the medium term? In our view, what's underpinning the relatively pessimistic growth projections for China is that the investment-led growth model pursued by China in the past was widely successful, has now run its course. Much of the investment was directed at housing as well as infrastructure investment. The housing investment is not coming back in a material way, and infrastructure investment is now facing diminishing productivity, as I had shown earlier. And so essentially, when we look at marginal product of capital at the aggregate level, we see it declining. It has already declined quite sharply in past years. Other factors impinging on Chinese growth potential is subdued productivity growth, which is in large part due to the high share of state-owned enterprises in China. So the left-hand side chart is based on a working paper from a couple of years ago. Again, it's very detailed, sort of firm-level analysis, and it shows essentially that SOEs tend to have lower productivity than private firms in the same sector, and it applies to manufacturing as well as services. So that's this. You see the distribution for SOEs, which is red, is to the left of private enterprises. So that's one of the reasons productivity has weakened over time, because of the high share of SOEs. More broadly, resource misallocation in China has grown, and that has weighed on Chinese growth potential. Also, of course, as is well known, demographics will also drag on Chinese growth potential going forward, and that's what the right chart speaks to. I didn't touch on this in the charts, but there are other factors which weaken China's growth potential or pose as a drag. There are internal barriers. So the domestic market is fragmented and not unified, and that's another issue. So as a result, putting all of these factors together, we expect, as I had mentioned, we expect 4 or 5 years out growth to be around 3.5% in China, and that's what this shows. We revisited our medium-term outlook for China last year. And so this is quite a substantial downgrade relative to even 2 years ago, when we thought China's medium-term growth would be in the neighborhood of around 5%. So what we are recommending is essentially a new growth model for China. Some of these things we have said at the IMF for many years. We think there's a need to, let me just summarize briefly. We think there's a need to rebalance Chinese growth towards consumption and away from over-reliance on infrastructure. We think, as I'd mentioned before, that there's a need to improve social safety nets. There's a need to increase the progressivity of the tax system. SOE reforms, as I'd mentioned before, there's a productivity gap, so that needs to be closed. And the way you do that, I think in our view, is to reduce the preferential access that SOEs have to credit, to land, to a variety of factors of production. There is a need also to scale back industrial policies, which contribute to resource misallocation and waste potentially, and they also feed fragmentation pressures. As I'd mentioned earlier, there are also barriers to interprovincial trade, which can be reduced, and you could unify the domestic market, which is a difficult reform, but that would have tremendous payoff in our view. And of course, then there's pension reforms to mitigate the impact of the declining workforce going forward. So I think all of these together can lift Chinese potential growth. Again, important for China, but also important for the rest of the world. We have done some model-based analysis, which shows that a comprehensive set of reforms to lift productivity growth and also pension reforms can lift Chinese GDP levels by around 2.5% over the medium term, which is 5 years, and around 20% relative to our baseline of no reforms over the long term. So the payoff can be quite substantial. Doing these reforms will also yield more domestic consumption and higher welfare. It would also mean less reliance on debt financing and a safer financial system. Now, let me move on to the final part of the presentation, and I'll be very quick on this. But I think it's important, given, I think, the conjuncture and potential for spillovers, rising fragmentation. I think it's at the top of mind of everybody. So this slide speaks to what would be the impact of a slowdown in China on the rest of the world. And again, I won't really get into the left-hand side chart because this is very well known, but essentially China is now the second largest economy measured in terms of market exchange rates. And as China's importance in the global economy grew, it also became a key trading partner for most economies. Its share in global trade rose rapidly, as well as is well known, and China became increasingly integrated into global value chains. I think here you can see the trade exposure to China. You can see that Asia in particular benefited disproportionately from China's rising trade integration. And you can see that trade with China increased by over 10 percentage points of GDP for a number of economies over the last 20 years, with the largest rise being seen in ASEAN economies and Korea. These are the bars on the left-hand side. And so what does this mean? As China plays a larger role in the global economy, it means that shocks originating in China are likely to have a more significant spillover to other countries. So the right-hand side chart shows estimates of long-term spillovers, not cyclical spillovers, but long-term spillovers from a 1 percentage point change in Chinese growth. It's based on a multi-country, multi-sector DSGE model. And the bottom line is that the spillovers for large ASEAN economies and Korea can be in the range of 0.15 to 0.2 percentage points, given the large trade exposures these economies have to China. Turning now to fragmentation, there's clearly growing concerns that there's going to be significant de-risking pressures, and this could reverse the gains from globalization that we have seen in recent decades. If you look at corporate presentations or government strategies, there's increasing discussion of the need for reshoring, for friendshoring. Now, what do these terms mean? Friendshoring is essentially how much do countries want to change their trade links between different foreign sources, essentially moving away from geopolitical rivals towards friends in terms of sourcing inputs and trade. And reshoring, of course, is moving production entirely onshore. So along both of these dimensions, we consider, again, it's a model-based analysis where trade between China and the OECD is reverted back to 2000, just before China's entry into the world, into the WTO. And so the chart on the right-hand side shows the simulation results. In a friendshoring scenario, global GDP declines by 1.8%, with economic losses being the largest in China at around 6%. I think what's very interesting in the friendshoring scenario is that the rest of the world doesn't actually gain, which is what, I think many bystander or third countries view the retreat from China as an opportunity. But what our analysis, in a general equilibrium sense, shows is that because of the slowdown in China and the OECD, other countries will not stand to benefit. So the trade diversion benefits that are commonly sort of spoken about don't really materialize in this scenario. And the slowdown in large countries offsets any such gains. In a reshoring scenario where production is moved onshore in the OECD, global output losses, I think unsurprisingly, are larger at around 4.5% of GDP. China experiences a significant loss, with GDP falling by around 7%, and the rest of the world loses more as well. So against this background, just to summarize, we think that shocks in China, given its large role, have significant global spillovers, with Asia being the most exposed. I think commodity exporters are also exposed naturally. And we think that fragmentation pressures are on the rise. We think the economic costs from fragmentation will entail significant losses on economies. So I showed you one scenario. The fund has done other analysis which factors in additional channels where the GDP losses can be as high as between 7 to 12%. So, the point is not the number. The point is economic losses are going to be significant with rising fragmentation. We think, as a multilateral institution, we strongly advocate for multilateralism. And we think it's important to avoid discriminatory practices. It's important to maintain a dialogue to discuss sort of legitimate concerns, of course. So I think with that, let me stop. I did go quite over, but maybe we can take a few questions. Thank you.
Thank you, Sonali, for a very insightful overview and presentation. I'm sure the audience has found it very informative and a lot of things to go over and think about. And I already see hands up. I won't use the time for myself. I'll just turn it to my, I turn it to my co-organizer, Professor Stephen Kapp.
Thank you very much for this very comprehensive analytical tour. It was very helpful. I have a question in terms of spillover effects. You took us through the trade channel and you took us through the supply chain channel. I'm also wondering, based upon sort of your analysis about financial stress and slower growth trajectories in the financial sector, if you talk about the financial channel on overseas investments and financing, particularly the ability of China, given these stresses, to continue investments with one of our later panels today, the BRI and other such initiatives.
Yeah, take a bunch of questions or one.
Yeah, we can take several questions and then
However you want to do that.
Yeah, thank you again. A lot of amazing information in there. I had a question regarding kind of off the bat, you said the IMF would prescribe more, using more monetary policy tools rather than fiscal expansion to address some of these issues. But then you kind of covered a lot of fiscal issues like local government debt, need for increased social safety net. And I assume those, are costs that maybe, they'd have to cut costs in SOE and, foreign aid spending and things of that nature. But what are those monetary policy tools in terms of, would decreasing interest rates unlock some of that private consumption and drive growth? Or is that also, easier access to capital also a problem in real estate in the first place, right? So how do they kind of square that circle with access to capital?
Okay. Maybe I can take those two. And
oh yeah, sure, you can.
okay, so on the first question, yes. So the analysis that I showed was primarily based on trade linkages and supply chains. In terms of financial spillovers, I think so there is clearly financial fragmentation at play. So we're doing some new work looking at outward FDI from China and inward FDI, and you see very interesting things there. I think for the Chinese economy itself, China is not that financially integrated. So it matters for the recipient countries, whether it's loans, debt, etc. But for the Chinese economy itself, it's financially, capital controls are still in place. They're financially, I would say, segregated from the rest of the world, broadly speaking. So I think the financial channel is not going to be that, if you think about the impact on the Chinese economy, it's not going to be a significant conduit. Having said that, you're seeing rising Chinese FDI going, so there's less in terms of sort of BRI loans. We've seen a decline of those for a variety of reasons. But there is increasing Chinese FDI to other countries, in particular ASEAN, as the expectation is that trade would follow financial flows with Chinese factories setting up elsewhere. So on the second question, in terms of the mix of policies, I think our recommendation is not where there's a lot of fiscal advice there. It's more in terms of reorientation rather than spending a lot. It's what you spend on. And in terms of monetary policy, what we're saying is they should rely more on interest rates, which are more effective at channeling credit to the sectors that really need it, that are credit constrained. So some of the smaller firms. The channels through which this can help is it could boost private investment and hopefully unlock productivity and innovation gains in the private sector, rather than consumption per se.
Take one more question.
Okay. Hi, I'm John Helveson. I'm from the School of Engineering here at GW. When Janet Yellen came back, there's been a lot of discussion about overcapacity now. This is a common word we hear. I'm curious your thoughts about that as a problem, or and also sort of in contrast to the point you raised about historic low consumptions in China, maybe there's just a imbalance there. So is this a real problem, or is this a political strategy here to justify our own industrial policy in the U.S.? I'm curious your thoughts.
That's a great question. So on overcapacity, I mean, this is not a new problem. It is, I would say, it is a problem, and it is a macroeconomic issue as well. But when you have weak demand in China, you have additional impetus to increase the productive capacity of the economy amid sort of weak demand. There's naturally going to be economic slack. There's downward pressure on. So abstracting away from the politics of it and the sectors that are sensitive, I think there is clearly a macroeconomic issue with weak demand, excess supply, deflationary pressures, increased debt, which my presentation spoke to all of this, and so it is a macroeconomic issue. I would say it's not a new issue in China. I mean, overcapacity has been. It's a feature of the system in the last 10, 15 years. We saw significant buildup of overcapacity in steel and other sectors in the mid-2010s, and there was a concerted government effort to reduce capacity. There were quantitative targets, and they cut it. So I think it's not a new issue. I would also say it's a feature of the system where their priorities set at the central government level. I'm not talking about the current conjuncture and EVs or whatever, but more broadly, if you even look back to the 2010s, their priority center is the central government. Then all the various provinces and local governments would go and invest in those sectors amid soft budget constraints, a banking sector that is very eager to provide credit for the preferred sectors. There would be a buildup of excess capacity, and then there would be a recognition of that issue. And I think the government is very cognizant of overcapacity risks. They've mentioned it in the December Economic Work Conference as well. And then there will be, in the past at least, there is an attempt to address that. I think some of this probably exists. I think you would look to sort of capacity utilization data. You see some evidence of increasing overcapacity.
So we have a question from online. Our distinguished visiting scholar, Ajay Chihibur, says, I have heard that China's social safety nets and insurance systems remain weak. Strengthening these will help increase consumption, as people now do a lot of precautionary savings. Rebalancing from investment to consumption may also be helped by these types of policies. I didn't see a mention of this. Do you have any views? That could be very, very helpful.
And this is something that I maybe didn't come out very clearly, but that's very much our view, that there is the social protection system is very weak. It needs to be ramped up structurally. I gave the examples of unemployment insurance, but the same thing applies to medical insurance. And rebalancing, I think it's very difficult to rebalance towards consumption away from investment in the absence of a stronger social safety net, because households will be faced with shocks. There is an incentive to self-insure at this point in time, and that incentive remains intact. So there is a need for structurally strengthen social safety net to deliver more balanced growth, but also to deliver greater welfare.
Okay. Question. Yeah. It's interesting to see the yields different of the interest rate you showed. It seems that the average cost of the local government financial institution is 2%, whereas like those banks are still like getting 4.5% of yields. So what level would be the dangerous? Local government would still say, okay, we have a lot of debts, but those interest payback is only 2%. So maybe in the long run, it doesn't matter.
Yeah, so I think it's true, as I had mentioned, because of ample domestic savings, because of financial repression and sort of guidance on interest rates. It's true that financing costs are lower than what they would be in a counterfactual of where interest rates would be much more market determined. I would say even with those low interest rates, many LGFAs are not able to service even their interest costs. So I think the pressures are already there, and I think it's of course obvious that if interest rates creep up in the future, that the financial pressures will become even more difficult, which goes to my point of the need to restructure this debt, because even with current low financing costs, they are not able to meet their rollover needs.
We have time for one last question.
Yeah. Oh, okay. So actually, it's two-part question. One is related to the last one. What proportion of the real estate sector, I meant on the real side, the developers we're talking about, are actually state-owned versus participation? I mean, Chiang Kai-shek's work shows that actually those lines are very blurry. So none of these type of instruments actually work because there's so many interlinkages. The second part of it is,
Question is that how
when you try to resolve, the type of things, you have all these chains and interlinked sort of contracts between state, local, and private, because virtually every private developer also has a participation by either local or central. So all those things, the political economy is very different, and the reform, and that's the best explanation of what has happened and what is not. But I don't expect you to have, we can have that discussion offline. But what I'm trying to figure out is what proportion of that sector is really a pure private sector that would be amenable to these instruments versus local government, which acts differently, versus some participation. The second part is that since your model about spillovers is basically a trade come investment model, as opposed to not taking financial, what role does the centrality of China as an export destination, as opposed to, as an exporter of overcapacity, et cetera, play in the spillovers? Because what has happened over the last 2 decades is China's importance as an export destination explains a lot of economic flows as well as political economy. That's why Germany acts the way it does. So can you split those? And lastly,
sorry. I think the
These
last
are very
question was not
challenging
good.
questions
Yeah,
already.
Yeah. No, I think in terms of, the line between the state and the private sector, I would argue that you could say that that line is more difficult to distinguish in the other sectors. I mean, there's some truly private sector developers in China. They, of course, benefit from local connections the way that China works. I mean, that is pretty clear. I think the fact that financial support is not being delivered is an indication that they are truly private sector, because the concern is, I mean, I think that's what not caused all of this, but that's what triggered the 3 red lines. The fact that these private sector developers were becoming over indebted. If it was all state owned, this is not how it would have gone down. So I would argue the other way around. I would also say that at this point, you see the financial stress spreading from purely private sector. That's what was the case, I would say, about 18 months ago. Now, even state-owned developers are facing financing constraints. I mean, they're having their access to capital curtailed significantly. The second question, I'm not entirely sure of what the question was, but just to say that this is the spillovers channel is that we have, this is a purely trade. This is a trade model here, which basically says your non-tariff barriers go back to where they were as a modeling simplification, go back to sort of pre-WTO. What does that mean for trade flows?
okay, no discrimination, just too short.
I guess our last panel of the conference can tell us more about the trade aspect
Yes.
of the spillover and how that affects.
My
the rest of
colleague
the
is coming
world.
for that
Yes,
from the
also
conference.
from
So you'll
IMF
hear
and
directly from them.
And then
Yeah.
for more
Okay.
Thank you so much for
You're
such a
welcome.
wonderful presentation.
Thank you. Thank you for having me.